You ever get the feeling that building real wealth is a game that's just not for you? Like it's reserved for people with huge incomes or someone who got super lucky? Well, that's a really common feeling. But today, we're going to take that idea and we're going to flip it on its head. We're going to break down a system, step by step, that doesn't need a massive salary. It just needs something you already have, a little bit of daily discipline.
So let's just cut right to the chase. A six-figure portfolio. In 5 years? I know. That sounds like the headline from some get-rich-quick book, right? But what if it isn't a fantasy? What if it's not about luck at all, but just simple math? Let's dig in and see how this isn't just possible, it's actually predictable.
And there it is. That's the number. This is the entire key to the whole system. Not 50,000, not even 500, just 50 bucks. It seems almost too small to matter, doesn't it? But trust me, you can't be fooled by the size. This isn't just a number. It's a daily promise you make to yourself, and it's the seed from which some serious wealth is about to grow.
So we need to completely reframe how we think about this. That $50, that's not money you're just saving. No, it's the daily fuel you're putting into a powerful wealth-building engine. And right here in this explainer, we're going to build that engine together, piece by piece. And we're going to start with the most important part, finding that daily fuel.
Okay, welcome to part one, the fuel. Look, before we can even begin to talk about awesome growth or stocks or any fancy strategies, we have to solve the very first problem. How do you actually, reliably, come up with an extra $50 every single day? This is where we need to talk about a concept called the microdelta. So what on earth is a microdelta? It's just a fancy name for that small, daily chunk of extra cash. But here's the genius of thinking about it this way. It's a total psychological hack. If I told you that you need to find an extra $1,500 a month to invest, you might just tune out. That sounds like a huge, intimidating mountain to climb. But breaking it down to just $50 a day, all of a sudden that feels doable, right? It changes the whole game from a massive monthly goal to a small daily action. And really, there are two main levers you can pull to create this daily surplus. The first one is expense auditing. Cutting costs. This creates your floor. It's the baseline you can hit just by being smarter with the money you already have. But the second lever, income generation, that's where things get exciting. That's what sets your ceiling. Actively earning more isn't just about hitting the $50 goal, it's about blowing past it and putting this whole thing into hyperdrive. And this table perfectly illustrates the whole idea of working smarter, not harder. Just look at this. To make your 50 bucks, you could spend, maybe 3 hours driving for a rideshare service? Or you could take a skill you already have, something you're an expert in, and earn that same $50 in 15 minutes. See the difference? The goal isn't just to make money, it's to do it efficiently. It's about focusing on high-margin stuff that pays you for your brain, not just your time. So let's make this super concrete. We're talking about micro hustles. Think small, quick bursts of high-value work. For example, if you're a great writer, maybe you offer to proofread a company's email newsletter during your lunch break. If you're a designer, maybe you whip up a quick social media graphic for a local business. Are you a programmer? You could do a quick 20-minute bug fix. A musician? Record a 30-second jingle. The key is to find something you're already good at and turn it into a quick, high-paying gig. Okay, so we figured out how to get our daily fuel. Now it's time to build the actual engine. Let's move on to part two and talk about the heart of this whole strategy. The absolutely incredible, almost magical force of compound interest. This right here is where that little $50 bill starts to turn into something huge. Now, I'm sure you've heard the term before, but let's really get it. Compound interest is just interest earning its own interest. As NerdWallet puts it, you earn on your original cash and on the interest that just keeps piling up. The best way to think about it is like a snowball rolling down a really big hill. It starts out tiny, right? But with every single turn, it picks up more snow, getting bigger and faster and bigger. Your money does the exact same thing. Your earnings start to generate their own earnings. So how fast does our snowball grow? Well, that depends on how steep the hill is. And in our world, that's the rate of return on our investments. A 7% return is pretty conservative, what you might get from a balanced portfolio. 10%? That's the long-term historical average of the S&P 500, the big 500 US companies. But for this strategy, to really get that engine roaring, we're aiming for a more aggressive target, somewhere in the 12 to 15% range, which is pretty common for portfolios focused on growth stocks. And here it is. This is the hero slide. This table shows you the raw, undeniable power of being consistent. Just take a second and really let these numbers sink in. Even with a pretty conservative 7% return, you cross that $100,000 mark in 5 years. At the market average of 10%, you're pushing almost $118,000. And just look at that 15% column, over $135,000. Check out year 3 at 10%. You're at 63 grand. Just 2 years later, it's almost doubled. This isn't luck. This is the predictable result of feeding the engine $50 of fuel every day for 60 straight months.
Now this is where it gets really crazy. By the end of those 5 years, in that 10% model, you're still putting in your $1,500 a month, but your investment earnings, the interest, is now doing over 63% of the heavy lifting each month. That is the tipping point, my friends. That's the moment when the snowball has gotten so big, its own momentum is now way more powerful than the little push you give it. Your money is officially working harder than you are. But okay, building this massive snowball comes with one giant risk. What happens when the market tanks? This quote from Kiplinger is so important. A 50% loss means you need a 100% gain just to break even. So protecting our portfolio from those big downturns is every bit as important as chasing those returns. You cannot let this snowball melt. Which brings us right to part 3, the framework. We have the fuel, we have the engine. Now we need the chassis, the safety system, to protect it from all the bumps and potholes in the road. And for that, we're going to use a professional-grade risk management system called the 2-3-5 bucket strategy. And believe me, it is way simpler than it sounds. Okay, so let's break it down. 3 buckets. Bucket number 1 is your liquidity. This holds about 2 years of your living expenses in straight-up cash or a high-yield savings account. It's for emergencies, for right now. Bucket number 2 is for stability. This one holds about 3 years of expenses in safer stuff like bonds. Its main job is to refill your cash bucket. And finally, bucket number 3 is for growth. This is where everything else goes. This is the primary home for your $50 a day. This bucket is the engine. So what's the whole point of this? Well, this structure creates a financial firewall. When the stock market has a meltdown, and believe me, it will, you are never forced to sell your stocks from bucket 3 at the absolute worst time just to pay your bills. Nope. Instead, you just live off the cash in bucket 1. This gives your growth assets the time they desperately need to recover. It literally protects your compounding engine from being destroyed mid-cycle. So let's just imagine how the money flows between these. Your daily $50 fills up bucket 1 first, then spills over into bucket 2, and finally overflows into bucket 3. Now, when the market is down, you just pull spending money from your cash bucket. When things are stable and calm, you sell a few bonds from bucket 2 to top off your cash. And when the market is booming, you trim a little of the profit from your stocks in bucket 3 to refill both of the other buckets. It's a closed-loop, self-sustaining system. It's beautiful. So we've done it. We've built the whole machine. We've got the fuel, we've got the engine, and we've got the protective framework around it. But, and this is a big but, the best financial plan on planet Earth is completely useless if you don't actually do it consistently. And that brings us to our conclusion, the psychology of success, and the single most powerful tool you have to guarantee it, automation. This quote really gets right to the heart of why most financial plans end up failing. Let's be real, willpower is a limited resource. If you have to wake up every single morning and manually make the decision to save and invest that $50, eventually you're going to fail. You'll get tired, you'll forget, you'll see something you want to buy. Automation takes that daily decision and all the fatigue that comes with it completely off the table. So how do you actually do this? It's ridiculously simple. Log into your bank's website right now and set up a reoccurring automatic transfer. You can do $50 a day, or what's probably easier, $350 once a week. The absolute key here is to start treating this transfer just like any other bill. It is a non-negotiable payment to your future self. It's not extra money. It is a fixed need, just like your rent or your mortgage payment. And look, if you only take one single thing away from this entire explainer, please let it be this. This whole system proves that the amount of money you start with is almost irrelevant. The true engine of wealth isn't having a big pile of cash to begin with. It is the relentless, unstoppable power of a consistent habit. Let me just say that one more time. Mega wealth isn't some random lottery ticket you might stumble upon. It is a predictable outcome. It's the inevitable result of stacking these small, disciplined daily actions, these micro habits, one on top of the other, day after day, month after month, year after year. The math simply does not lie. We've laid out the entire blueprint for you. The theory is over. The snowball is just sitting there right at the top of the hill, and it's just waiting for that first little push. So really the only question left is the one on your screen. What are you going to do with your first $50?